Hey guys, Jack Spirko here. We're going to do a kind of a short video today. It was an unplanned live as I decided to set up my segment for today's Expert Council show. I thought that I kind of want this one to have a breakout, shareable, short 10, 15 minutes that it can be done on its own. So why not go ahead and record a video? So that's what that is. But today's episode of the Survival Podcast, which will be due out pretty soon after I'm done with this, is episode 3607. A lot of great stuff in it beyond just Bitcoin. But if you just want to know about Bitcoin, well, that's why we're doing this as a breakout segment. So let's talk about Bitcoin today in a way that maybe you've never thought about it before. And we're talking about just Bitcoin for this subject, though silver and gold are going to come into this a little bit. But like many of you, I have seen various memes over the years that show how devaluing the currency has devalued human labor. And you usually see it as something to the effect of, here's 5 quarters. This was the minimum wage before they demonetized silver out of our coinage. And today, if you had this much silver, it would be worth 30 something bucks. And the minimum wage would be $35 in value, not necessarily dollars. And I've seen that over and over and over again. And I've always really thought it was actually a very powerful concept. But it wasn't until my winter shutdown in between, the beginning of Christmas through New Year's, that at some point I saw somebody post something in that vein again, and something clicked for me. And I'm going to bet none of you have ever heard anybody talk about Bitcoin this way before. Digital gold, sure, yada, yada. But a different concept about the adoption of a new store of wealth and monetary instrument that is Bitcoin, an absolute scarce, enforced by network, absolute scarcity as a means of storing value or being paid for your value. So I don't think people really grasp the meme we started off with about the quarters sufficiently. So I'm going to start there. So for most of America's history, from our founding up until, I'm even going to let the Federal Reserve thing go, except we did have that whole crime of 1873 with the initial demonetization of silver. But even 1913, if you actually look, everybody always wants to start the graph there because we all, with justification, hate the Fed. But, the dollar's lost 99.98% of its value. So go back to 1932, right before FDR revalued gold at $36 or $33, whatever it was, versus 20, and did that big devaluation. Go back just before then, and you'll see that the inflation, not supply and demand, because supply and demand hits different commodities at different times. But the actual inflation rate between 1913 and 1933 wasn't really that big a deal. It was that decoupling and then fractionalizing the gold value against the dollar and revaluing gold where the big dip hit. But then if you look at that, from 1933, again, eliminate the supply-demand curve on different commodities and the effect of World War II and all, through the 60s and into the 70s, inflation was not great, but it wasn't that bad. We'll go to 1971, baby, when we finally said, the hell with any anchor whatsoever. 1971, and that was where the majority of inflation occurred. And if you go and you look up the site, what the fuck happened in 1971, you can see that when we went full fiat everywhere. Administrators versus teachers, administrators versus doctors and nurses, seed oils, fiat food, the value of housing, the cost of an education. 1971 is where everything went to shit. So that's a little over 50 years now. For a little over 50 years, human labor, human effort, and when I say human labor, I'm not talking like a communist here. I don't mean you showed up and sat at a desk. I mean actual productivity, whether you were running a business or working for somebody, you were receiving fiat in return for the value you were creating. And this fiat, the stated goal is to devalue it by 2 to 4% per annum. That's per year, for those that don't speak big words. And the Federal Reserve's actually been pretty decent at it. There's been times where it's got away from them. It's been upward of 13%. But in general, 2 to 4%, they've been able to do that. And it's cancer. It's cancer to the value of your surplus energy. So you get paid, you spend a certain amount of money to do things, and then you save a certain amount of your money. And humans have been forced into first mutual funds, then ETFs as investment schemes to combat inflation. They actually sell it to you that way. The financial liar comes to your work and says, you should invest in this. And if you're young, just go crazy, put as much as you can in the most risky shit possible, because over time it'll work out anyway. And these markets have been propped up. I actually authored an article while I was in shutdown mode. You can look it up on the site. And it's about how an experiment has been done many times where people have thrown darts at stock sheets and outperformed professional money managers, because the whole thing is an artificially inflated thing. And that is because your surplus labor is now going into this money market, or not money market, this investing scheme that values companies at far more than their production is worth. And it can only be fueled by printing money. But what that really means is that you, when you are compensated in dollars, are being compensated in a faulty currency that will devalue over time. Meaning, if you just take your money and you save it, you are paid, let's say X is your labor rate today. Tomorrow, you're worth more money than today if you get better at it. So you might get X plus, but it doesn't matter, because whatever you're saving is X minus. You cannot save your way to wealth in a fiat system. You can't do it. That's why we all have investments, whether we invest in real estate, we build businesses that have underlying equity value, we buy gold, we buy silver, we buy stocks, we buy mutual funds, we invest in other commodities. Whatever we do this mainly, we take the risk because that risk is less than the risk of simply storing the money. But again, this is all because you have been compensated with a faulty method of delivering value back to you for the value you put in. Okay? Now, let's think about this as a new monetary instrument that is Bitcoin. Genesis comes in, what was it, 08 and 09, and there's very little adoption. And then about 2010, 2011, you could actually go buy it on an exchange. You could store it. People started using it. People started sending it back and forth. People bought pizzas with it, whatever. And some adopters early on said, wait a minute, not only do I think this is a freedom technology, not only do I think this is a method of payment, and as all the shit coins came out, some people had more clarity than even me and said, that is a shit coin. This is the thing. And they kept some of it. And all of us got the price we deserved. And we got the price we deserved for the initial Bitcoin we bought or we received as payment. And we got the price we deserved for the Bitcoin we didn't fucking spend. Now, as you introduce this is the part I don't think you've probably ever heard before. As you introduce this new monetary instrument and it begins to get adopted, okay, you begin to have this new form of currency adopted. All of the sudden, even if you're paid in dollars, if you're doing what I teach, which is sweep your surplus capital, if you're not going to buy an investment with it, if you're not going to pay a bill with it, if you're going to hold it as cash and you're going to hold that cash more than a year or two, put it in Bitcoin. And people begin to do that. The system that is out of order, the disorder of economics created by a fiat currency begins to correct. And people begin to be paid, even if they're paid in dollars, by converting the surplus to Bitcoin. They have made a decision. I will be compensated in a non-faulty currency, a non-faulty monetary instrument. I will have a better battery to store the value of my labor. But here's the thing. We have, young people that have been doing this 5 or 6 years, and they've managed in that 5 or 6 years by being good ants to stockpile 2 or 3 Bitcoin, $200,000 or $300,000. Now, no matter how unfairly compensated that person is, do you think, you're talking about people that are, middle income earners, maybe a little bit on the upper side of that, but they're people with tech jobs. Some of them are people that change tires for a living. I'm not putting this down. I'm just saying, is that job worth $100,000 a year or $200,000 a year that some of these people have amassed? The answer is no. The answer is no. So how simply by, is it just an investment scheme? No, it's not. It's a correction. But the people in the correction are receiving the correction en masse. In other words, all the people that fail to adopt this strategy are giving up their right to reclaim which they have lost. And so the person who was in this by 2015, 2016, 2017, and has consistently swept that surplus capital in, isn't just recapturing the unfair wage that they were paid. They're doing it with everybody else's, because everybody else is still living in the fiat fantasy. And this is indicative, okay? This is indicative of what happens when a new monetary asset is adopted, or when an old monetary asset, which is our oldest monetary assets are silver and gold. I should say our oldest lasting monetary assets that are still used are silver and gold. And silver and gold have been used and then devalued and then reintroduced. And whenever this happens, the people that get on board with it first tend to have the greatest benefit. But why? Again, I say that the real reason is that the correction is now being intercepted by the early adopter. In other words, I'm not just recouping the value of my labor, and I first started working about 1985. I'm not just recuperating my labor from 1985 to 2025. And the value of every bit of value I've put out in the world by adopting this new system of wealth storage, right? I am intercepting my father's and probably my grandfather's. Anybody who was working after 1971, the whole damn world. It's all up for grabs. I know that sounds a little crazy. I'm going to go deeper into this. I'm going to put some math behind it. I'm going to put some spreadsheets behind it and stuff. And I'm going to do like a full-on episode about just this, or maybe a split episode. It's half this and half something else in the next few weeks. But I wanted to drop that on you today. You're seeing a correction in the robbing of the value of human labor. And again, do not let the term human labor confuse you to be something like Marxist, communist, socialist mindset of human labor. You showed up, you were there, and therefore you're entitled to your equal share of what the person who risked everything to build the company you work for. No, I don't mean that. But I mean that you do bring some value, or nobody's going to pay you unless you work for government anyway. You could just hold down a desk for government, or a big enough bureaucratic company that's living off the tit of government and the tit of fiat. But if somebody hired you into a business that has like 12 employees in it, they're going to notice. They're going to notice if you're not contributing, and they're going to get rid of you one way or another. They'll either fire you or make your life so miserable you'll quit. It's better for them if you quit than if they have to fire you because of fiat mindset and government and interference and workers' comp. And trust me, if you've ever employed somebody, you know what I'm talking about. If you don't know what I'm talking about, you won't until you employ somebody. So that's a better way to get rid of somebody than outright termination, is to encourage them to go elsewhere. And that's what happens to people that don't. But if you are kept, you're working for a small business, whether you're busting tires or writing code, you have value. And I will tell you that most people, even though they think they're underpaid, aren't. You're being paid your market rate. The problem isn't the amount you're tendered that week. It's the value of what you were tendered that you didn't spend, what you used your own self-discipline to not take resources from others, to put it aside for later, the value of it in 1 year, 3 years, 5 years, and 10 years. That's the flaw. And so the longer you wait to correct that, the less of the correction you get. Right now, those of us who went first by taking the risk, we got everybody else's correction up to this point. And we're going to keep doing it. And it's up to you when you start doing it. That's just kind of a new way to think about Bitcoin. Again, this is from episode 3607 of thesurvivalpodcast.com. If you're watching me live, it'll be about 30 minutes before that whole episode's up. Lots of cool stuff in it today. Anyway, with that, I'm out, and I'll talk about this more in the future.